Hi, I'm Tim Sustak, Chief Credit Officer with Vizzo Financial, and this is the economic update for December 2017. Today, we'll take a look at the current yield curve, or lack of it, and what the Fed will do going into the new year. So, the yield curve is an interesting topic as of late, or at least the shape of it is. Typically, we think of the yield curve being upward sloping, that is, short-term rates are lower than longer-term rates as investors seek additional yield for the risk of a longer-term investment. Sometimes, though, the yield curve flattens, meaning the spread between the short and long end of the curve shrinks. Occasionally, the curve even inverts, meaning short-term rates are higher than long-term rates. Great, so what's the point? Well, many times a very flat or inverted curve is a predictor of economic recession. Looking at the spread between the 2- and 10-year Treasury, the yield curve is certainly flattened this year, going from about 125 basis points to start the year to currently around 56 basis points, certainly fairly flat historically. Lots of theories exist as to why the curve is flattened this year. The basic theme is a combination of the Fed raising short-term rates, while inflation expectations are low, which keeps longer-term rates anchored. Currently, though, there are other factors in the mix that are affecting the curve, such as the process by which the Fed is shrinking its balance sheet, as well as foreign dollars chasing U.S. debt as rates are very low across the globe. This is some thinking that the current flattening of the yield curve may not be the same situation as we have experienced in the past. Whatever the truth is to that story, we do know that the flattening yield curve could mean a recession is nearing. It does not necessarily point to an inevitable near-term recession, as the yield curve has sometimes flattened for years, or gone through flattening and steepening cycles before there was ever an inversion or recession. Although the new normal that everyone likes to talk about could be playing havoc with the curve, it's still worth watching, as the yield curve remains one of our best indicators of where we are in the economic cycle. After the break, a look at what the Fed is predicting they will do to influence the short end of the curve in the coming year.
There we go. How much was that again? 91. Do they use Zlotys or Coronas here? 91. What country are we in today? Thank you.
Traveling is supposed to be a fun experience. Make sure your members' adventures are unforgettable with my CU Services prepaid foreign currency card.
Welcome back. The Fed chose to raise the funds rate 25 basis points at its last meeting of 2017. What will they do in 2018? Well, their most recent projections indicate 3 25 basis point hikes in 2018, and the markets are currently expecting about a 70% chance that the first one comes at the March meeting. FOMC Chair Yellen gave her final post-meeting press conference after the December meeting, and she gave us no reason to believe that there is any plan for the FOMC to stray from the gradual increase mindset that they have had since they began to raise rates 2 years ago. The FOMC still believes that gradual increases in the funds rate are necessary to keep a strong labor market from getting ahead of them. However, they're also watching the inflation numbers that have been weak and persisting below their 2% goal, that they continue to believe that inflation will stabilize at their desired level over the next couple of years. That sentiment supports gradual increases in the funds rate until something substantial changes, and all indications are that our new FOMC chair, Jay Powell, will continue along this path. Thanks for watching the economic update for December 2017. Here are this month's release dates for some of the more important economic statistics. I hope you all have a great holiday season. We'll see you in the new year. Thanks for watching.